Hello students, welcome to your third module. So in our first two modules, we had discussed various aspects related to your investment management. In our first module, we studied what exactly is investment analysis about. We discussed what are the various securities available, what is meant by stocks, bonds, debentures, and we saw what are their pros and cons. Also, we saw various aspects of investments. In our second module, we saw what is meant by risk, what is meant by return, and how they actually work. Correct. So in our today's session, we'll discuss about security analysis. So what is meant by security analysis? Now that we have studied what is investment, what is risk, what is return. Correct. Now, after knowing these basic concepts, if I want to purchase a stock or a bond in the share market, right? What are the key aspects that I need to check for? Correct? These things, these key aspects of a stock or bond will be analyzed before investing in that particular share. For example, if I want to purchase a stock of Reliance Industries today, I, I mean, what are the aspects I need to consider before investing, right? That is about your security analysis. Now, there are two things to this security analysis. First one, fundamental analysis. Second is your uh, technical analysis, right? So there's first thing, fundamental analysis. Second is your technical analysis. There are two different types of analysis. Okay. First in our today's session, let us discuss about fundamental analysis. This fundamental analysis has something called as EIC framework. E stands for economic analysis, I stands for industry analysis, C stands for company analysis. Now, let's get started with fundamental analysis. Fundamental analysis is the examination of various factors such as earnings of the company, growth rate, and risk exposure that actually affects the value of shares of the company. Correct? So, fundamental analysis actually verifies all those factors like your earnings of the company or what are the dividend payout ratio and analyzing what that company is exactly into and what is the risk exposure. Risk exposure is like few companies, like what we call them as evergreen companies. The companies like oil and gas or fuel, these things are always required in a steady state. Correct? It's not like one day the consumption is too high and the next day the consumption falls down to the rock bottom. It doesn't work like that. In those industries, the risk exposure is little less, you know because it is like one of the essential commodity which people have to purchase no matter what. Without those things, transportation will not work. If transportation doesn't work, most of the things in the economy or country will fall down. Correct. So this is the reason there are few companies or few industries whose risk exposure is little less. So this is the concept of fundamental analysis. You need to analyze how exactly is that particular stock placed. To understand that, we need to go through something called as EIC framework, which I just now mentioned. E stands for economic analysis. So we'll see what is economic analysis. I hope you guys are aware of what is meant by economy as a whole, right? Economy can be like, it could consist of various macroeconomic factors, right? Macroeconomic factors of a particular nation or country. The various macroeconomic factors are gross domestic product, next is your savings and investment, inflation, interest rate, budget, tax structure, right? These are the major economic factors. So now we please do not lose this flow. First is economy analysis. Economic analysis. When I say economic analysis, what are the economic factors that affect the particular companies or particular stocks or particular share market? Correct? The share market is directly related to your economic, aspects. Those economic aspects or macroeconomic factors are: first is your GDP. I hope you guys know what is meant by gross domestic product. Gross domestic product is nothing but the sum total of all those. I mean, the sum total of the value of goods and services produced in that particular country. We call it as gross domestic product. So, what is the actual amount of GDP of that particular country, and how exactly is it working? Second is your savings and investment. In our previous sessions, we have discussed how savings and investment work. Correct? If I am left with some surplus funds, that surplus funds I can keep it with myself, or I'll go ahead and invest. Correct? If there are more salaries given to the professionals like me, we would like to save it and invest it. Correct? When investment increases, there are new companies, or the funds are provided in excess for the companies. The companies utilize it to produce more and more goods. When more and more goods are produced, that particular company will have employed so many employees. The employees are paid more, and if employees are paid more, these goods and services which are produced will be consumed more. If there are more and more goods and services consumed in an economy, the tax levied on that goods and services will also increase. I mean that government collects tax on all these goods and services produced in that economy. So if there is more tax collection, government will have, you know, a chance, or government will be in a position to invest more for the development of that country. I hope you guys understand how this the chain works, right? Next is inflation. Actually, if you ask me, it is better to be in an inflationary economy than deflationary economy, right? Let me explain this. What is the difference between inflation and deflation? In in case of inflationary economy, the prices of goods and services keeps on increasing. Suppose today I purchase this mobile phone for 30,000 rupees, right? Tomorrow it might be 31,000 or 30,500. You know that prices keeps on increasing. Forget about mobile phone. You know there are various strategies, so you guys might get confused. Coming to your rice, the staple food of India, rice. In case of rice, a particular quality of rice, if it is costing 60 rupees today, it will cost 65 tomorrow. Correct? It will get increased and it will never get decreased. That is one point to be considered in inflationary economy. So imagine there is a producer of rice. There is a farmer who produces rice. Initially, he was selling at 60 rupees, right? Now he is given a chance to sell at 65 rupees. Ultimately, that 5%, 5 rupees increase belong to the farmer. So farmer is, in a way encouraged to grow more. He tends to grow more and more rice, so that the price of rice in the market has increased, and that effect will pass on to the farmer. If he is earning 10,000 per month in the previous year, this year he will be earning 10,500 or 11,000 rupees. Correct? This is what happens in an inflationary economy. You can even take an example of employee, right? Employee is working for 25,000 first year. Second year he'll be paid 26,000 or 27,000, and the coming year he'll be paid 30,000, right? If this increases, they'll be motivated to work more. While let's analyze deflationary economy, right? What will happen in case of your deflationary economy? There, the value of goods and services keeps on decreasing. Imagine today a manufacturer or a farmer has produced 100 kgs of rice at 60 rupees, correct? So he wanted to sell it at 65 rupees. But tomorrow the price of the goods and services will go down. Imagine the price of goods and services came down to, sorry, the price of the rice of 100 kgs came down to 55 rupees. Now, the manufacturer or the farmer is at a loss of 5 rupees per kg, correct? So, they are actually discouraged to produce goods and services in deflationary economy. Who would want to actually, invest so much of money and incur losses, correct? So the economy will not flourish or will not even survive in case of deflationary economy. So it is better to have inflation. Also, one thing you need to keep in mind, so this particular year I'm paid a salary of 25,000 rupees. So I'll be saving some 3,000 rupees per month. That 3,000 will be invested in stock market. The next year my salary gets increased to 30,000 rupees. Now I'm not able to save 1,000 rupees also because of inflation. Inflation rate was too high in this past 1 year, so that price of goods and commodities went up to the sky. They shot up like anything, and I'm not able to save anything. Whatever I'm earning, I'm just surviving with that salary what I'm earning. Correct? That's how inflation works. If the inflation rate is very high, the people in the economy are unable to spend anything on the investment, or they are unable to invest any money in the economy. So if investment comes down, the production activities of the industries will also come down because they don't have enough funds for their investment in a particular sector, correct? So that's how inflation works. Next, coming to interest rate. If bank is paying me an interest rate of 8% per annum, and the returns on a particular stock is just 6%, what is the point in investing in that particular stock? Correct? I hope you guys are understanding this. Interest rate in the bank will have a major impact on the selection process of the stocks. If stock is not even paying interest rate or a return of a bank, right? I don't see any point in investing in that particular stock or share. So next is your budget. Budget, I hope you guys are aware what is a budget. Budget is like the amendments which are made by the finance minister of the country or state every year, right? Every year they'll have what are the actionables of that particular year. How are the revenue collected, and the revenues how are they spent, correct? They'll have a fixed portion of budget for your investments also. How to develop infrastructure, or does government have a plan of improving the economy this time? What are the economy revival strategies if there are any downfalls? Correct, those things will be covered under your budget, which is one of the most important aspect of economic analysis. Next is your tax structures. If I purchase a stock this year, or if I purchase a particular bond, what is the tax benefit I am availing, right? That is about your tax structures. These are the way macro economic factors which you need to consider before investing in that particular stock. So now that we have studied what are the economic factors or economic analysis, right, to consider before investing in a particular stock or share. Now let us understand what is meant by economic forecasting. Now that we know how exactly the economy is functioning, right? We know what are the what is the budget aspects, or we know what are the tax implications, or we know what is the inflation rate. So all these things we have studied. This is about what has happened till now, right? This particular year. Now economic forecasting is like foreseeing the next near future. So how do we do this with respect to economy, right? So forecasting the future state of economy is needed for decision making. Very true, right? For whatever decision you want to take today, you need to foresee what would happen in future because of my decision. So today, if I'm purchasing stocks or shares of Reliance Industries, what would be that implications of near future of the economy on these stocks? Correct? Will it grow or will it not grow? Or what is the dividends which can be expected, or what are their yield percentages? So for these things, we need economic forecasting. The following forecasting methods are used for analyzing the state of economy. First is economic indicators. So I have stated a few forecasting methods which can analyze the economy in the near future. What would happen to the economy in the near future? So what is economic indicators? Which actually tells you how exactly is the economy growing. If it is growing at 5%, we can expect that it might grow at 4% or 6% in the near future. Correct? That's how economic indicators work. What is their present status, progress, or slowdown? How is it going? Right? Next is your leading indicators. Indicate what is going to happen in the economy. Popular leading indicators are fiscal policy, monetary policy, rainfall, and capital investment. So let me take one simple thing here. Yeah, rainfall. So in monsoon. So now we are in the month of April. In May and June, if the rainfall is very low, you can expect drought in the next year. Correct? If there is drought in the next year, the production of food or the crops will not be grown in the expected to the expected level. That production of agricultural producers will go down. When agricultural producers go down, government tends to spend more and more in importing all these agricultural goods from other countries. So government is spending a lot of money here because it is the most basic aspect of human beings, right? Without food we cannot live, and if there is drought, the level of agricultural activities will go down. If level of agricultural producers go down, people tend to spend more. The prices will go up. When supply of agricultural producers go down, the demand for agricultural producers will increase. When demand increases, obviously the cost will also increase. So, if in case rainfall is very less this year, you can expect the economy slow down in the near future. That's how leading indicators work. Leading indicators give you signs now so that you can decide or you can think what would happen in the near future. Coincidental indicators indicate what the economy is. For example, if I give you the GDP growth rate, you can easily understand how exactly is the economy functioning, right? Or if I tell you the industrial production or interest rates, you can easily correlate those things with the economy. How healthy is my economy, right? Next, lagging indicators. Lagging indicators are like those indicators which are the effect of the economy slowdown or economic progress. So it is the changes occurring in leading and coincidental indicators are reflected in lagging indicators. So if economy is not doing well, if economy slowdown is there, you can foresee that impact on unemployment, right? The unemployment rate will increase because the industries are not working well, and if industries are not working well, they tend to remove employees, so that as a result of which the unemployment rate will increase in the economy. So unemployment rate is an example for lagging indicators. Some downfall in the economy has actually occurred. Those effect will be there on this unemployment rate. Correct? That's about your lagging indicators. Next is diffusion index. It is the consensus index which has been constructed by National Bureau of Economic Research in USA. So it is basically an index. So diffusion index, you can use it to analyze the economic state, right? Now this is about E in your EIC framework. So initially I mentioned about EIC framework. In that we have completed E. Let's move on to industry analysis. What is industry analysis? Industry analysis is used to analyze performance of industries over the years. So if you are, understanding what I'm telling, initially we studied economy as a whole. In that economy, we are studying the industry now. Next, we'll go to a particular company. As and when I'm explaining, I'm coming a little close to the stock or the share which you want to analyze. So industry analysis, it is used to analyze the performance of industries over the years. How well the industry is performing. If I want to, purchase Bharati Airtel's stock. So Bharti Airtel is into telecommunications. How far or how well is the telecommunication industry doing in this country from last 5 years or last 10 years, last 15 years? I will analyze what are the performance of the entire industry, not the stock alone. An industry is a group of firms that are engaged in production of similar goods and services. So this is the meaning of industry. What is meant by industry? Industry is like several similar firms come together who are into similar production activity or producing goods or services, right? So industries can be classified into two types. One is non-cyclical industry and another is cyclical industry. What is non-cyclical industry? Non-cyclical industry is like it doesn't have a proper cycle. It remains constant. For example, pharmaceutical industry or cigarette industry. These things, the demand for all these goods remain constant. It's not like it will increase in a certain period or it will decrease in a certain period. It remains constant throughout the period. That's what we mean by non-cyclical industry. Cyclical industry, growth and profitability of the industry move along with the business cycle, like automobile industry. Now automobile industry is actually into recovery phase. After that they'll see growth, then they'll see maturity, again they'll see decline, right? So, in case of non-cyclical industry, the risk factor will be comparatively less because the demand for their goods and services are constant. Correct. Now, an investor must analyze the following factors. So, what are the factors to keep in mind when analyzing a particular industry? First is growth of the industry. At what rate is the industry growing? Second, nature of the product. What is the product into? Is it into tobacco or is it into automobile or is it into clothing or fabrics or what exactly is that industry into? If we analyze the nature of product, is the product essential or is the product need or is the product luxury item, right? So we need to think about what exactly is the type of product. Next, government policy. When it comes to certain things like alcohol and other things, the government policies are very stringent on these things, right? When it comes to pharmaceutical industries, the government policies are stringent, but because government actually tends to provide a better service or to help the common public, right? It wants to help the public so that the prices of these things, the prices of these pharmaceutical producers are in a stable state, correct? Now, cost structure and profitability. What is their cost structure and how profitable are the goods of that particular industry, right? And we have various types of industries like oligopoly market or monopolistic market. You need to analyze what exactly is their marketability or profitability. Next is nature of competition. Just now I mentioned about oligopoly market. So what is their competitive strategy? What is their how well are they able to position their individual products. So, nature of competition. In case of all these car manufacturers, if Maruti Suzuki decreases the car price, you can see a similar effect on the car prices of Hyundai or Tata or Toyota or other brands. So this is how competition works in automobile industry. Also, if there is a particular season in which the car manufacturer sells cars at lower price or they start giving offers, the similar offers will be given by various other car manufacturers. That is the nature of competition. Next, let's analyze the company now. So now that we have decided which industry to invest in, let's decide a particular company here. So company analysis. In company analysis, the growth of the company is analyzed by the investors so that present and future value of the shares can be known.